Converting your C corporation to an S corporation can offer significant tax advantages. But what happens to your retained earnings during this transition? This critical aspect of conversion requires careful planning to avoid unexpected tax consequences. When a C corporation converts to an S corporation, the tax structure fundamentally changes. In a C corporation, the company pays corporate taxes on profits, and shareholders pay personal taxes on any dividends received. This creates the well-known double taxation issue. S corporations, however, operate as pass-through entities where profits flow directly to shareholders' personal tax returns, eliminating corporate-level taxation. Before considering conversion, you must ensure your business meets the IRS eligibility requirements. Your company must be a domestic corporation with no more than 100 shareholders. All shareholders must be United States citizens or residents, with certain trusts and estates also qualifying. Your corporation can have only one class of stock and cannot be an ineligible corporation like certain financial institutions or insurance companies. Failing to meet these requirements can result in automatic termination or rejection of S corporation status. When it comes to retained earnings, an S corporation can handle profits similarly to a C corporation. The company can distribute profits to shareholders, keep them as retained earnings, or do a combination of both. The key difference is that shareholders of an S corporation must pay taxes on all corporate profits, regardless of whether they receive distributions or the company retains the earnings. During conversion, retained earnings accumulated under C corporation status become part of the S corporation's accumulated earnings and profits, commonly referred to as E and P. This distinction matters because the IRS treats E and P separately from current year S corporation income. Distributions must first come from S corporation income, but any excess may draw from E and P, potentially triggering dividend treatment and additional taxation rather than tax-free distributions. This creates a potential problem for shareholders. They must pay taxes on profits, whether or not they receive distributions. For silent partners who have no say in reinvestment decisions, but still face tax obligations on undistributed earnings, this can be particularly problematic. One of the most significant tax implications when converting is the built-in gains tax, or BIG tax. This applies if the S corporation sells appreciated assets acquired during C corporation status within 5 years of conversion. The appreciation that occurred before the conversion becomes subject to tax at the highest corporate rate, separate from individual-level taxes on S corporation income. Many business owners plan around this by deferring asset sales or waiting out the 5-year period. Another risk comes from passive income derived from retained earnings. This includes rent, interest, dividends, and royalties. If your S corporation has accumulated E and P from its C corporation days and generates more than 25% of gross receipts from passive income for 3 consecutive years, it risks automatic revocation of S status. To mitigate this risk, consider distributing E and P, shifting your business model to generate more active income, or reclassifying passive income where legally appropriate. Successfully converting while managing retained earnings requires strategic planning. Track E and P separately to avoid dividend misclassification. Avoid early asset sales to reduce exposure to big tax. Distribute excess E and P to reduce the risk of termination from excess passive income. Review your ownership and shareholder structure to ensure IRS eligibility and conduct a pre-conversion tax review with a qualified tax advisor. While S corporation election offers significant tax advantages, mishandling retained earnings can lead to unintended taxes and complications. The conversion process affects how retained earnings are taxed and distributed, with accumulated earnings from the C corporation period potentially subject to built-in gains tax if assets are sold after conversion. Passive income from C corporation era retained earnings can trigger termination of S corporation status, if limits are exceeded. Effective planning strategies include carefully tracking earnings and profits, avoiding excess passive income, and managing appreciated assets. Remember that while an S corporation can maintain retained earnings, shareholders must still pay taxes on all profits, whether distributed or not. Consulting with legal counsel or a tax advisor can help mitigate tax liabilities and ensure compliance throughout the conversion process.